Friday.
Okay, everyone's. I think.
Hey guys, Happy Friday. It is Friday. Oh my gosh. This was a long week. Mm-hmm. We are also live on our Instagram page right now, so we're going to be kind of like multitasking. And share this out because we're going to cover a lot of things today. By the way, this is Finance Friday. If you didn't know, I'm a little rusty. This is the show where we transform your relationship with your money by giving you the information that you need to grow and protect your wealth. I'm Amy Novakovich, a certified financial planner and chartered retirement planning counselor. We got people popping up. Hey guys, hey everybody, happy Friday. Gotta support that. How can we support that?
This is heavier.
This is way heavier. See, I'm trying to multitask. We're live on Facebook and Instagram. So sorry, Instagram guys, right here. And this is Ryan Wilson.
Hey everyone.
Ryan's been gone for a few weeks. Well, no, you haven't been gone.
I haven't been gone. You guys have just been.
Well,
you've been doing interviews and stuff without me.
We were driving around in cars with people. So if you haven't checked out our Finance Friday or our podcast, I highly suggest that you go check it out on our Facebook page or go to our website and you can find all our media. So our website is novawealthmanagement.com. Our Instagram is @NovaWealthManagement. You can follow us on Twitter @NovaWealthManagement, but Twitter we're abbreviated MGMT. Are you live on Instagram now too? That microphone is right in my face. Oh. So we're trying to do 3?
Yeah.
We have Facebook and 2 Instagrams.
I need my single digit of followers to be able to see us.
The mic is in my face. I'm not going to just pay attention to that.
No, just talk. We're fine.
So what I like to do on these Finance Friday shows, I like to give away information, like a little tidbit before we get into the main subject. I like to give away information that is useful, a takeaway that you can use right away. So what I wanted to say is I get the question all the time is, and I'm sure Ryan does too, do I invest in gold? I want to invest in gold. Do I invest in gold? Well, let's look at, so history does not predict future.
Right.
But over the last 5 years, guess where gold was 5 years ago?
Oh,
now look at what you're doing.
Sorry, that microphone is.
Guess where gold was 5 years ago? Can you guess?
5 years ago.
Here, let me just tell you.
Okay.
Not much lower than where it is now.
I want to say it's like somewhere like 1,200%,
1,297. Yeah. 5 years ago today. So it is no dividends. Gold has no dividends. Dividends meaning income. Gold has no income. Oh, I like this. That was a good idea.
Yeah. Every once in a while.
So gold. Do I invest in gold? Gold has no income, right? Gold prices is where you make the money. Usually you buy gold and you hope it appreciates. So gold over the last 5 years has gone nowhere, guys. 1%. So am I saying should you invest in gold? That's not necessarily what I'm saying. I'm just saying be aware that even gold has risk, right? So it's a diversifier, meaning we don't want to own all one type of investment. So gold has not performed like the stock market. And so sometimes people say like, oh, I want gold when the market is crashing. And that usually is true, although it wasn't in December of this last quarter. But so just like anything else, I think it would be a good smaller portion of your overall portfolio, but don't get so excited when you see these commercials like, oh, gold, like invest in gold and your jewelry appreciates, like not necessarily. So I just want to throw that out.
Which I think also goes in if you're watching commercials about any type of investment that's like, oh, with the stock market,
Carl.
And they're using fear to kind of push something. So gold, there's a bunch of other ones, but just kind of keep in mind that if they're using the fear base, then just kind of take it with a grain of salt because generally they're taking advantage of the fact that there is a little bit of fear in the market right in this time.
Absolutely. Okay, so what are we talking about today? So again, we just like to give away a little bit of information that you can take away right away, just in case you can't stay on the whole time. But what we're talking about today is just like a first quarter update. We're at the end of the first quarter, last business day today. So let's talk about where we've been this first quarter, what's different from fourth quarter, and where we're going in second quarter. Yes, like where to put your money, what to do. So why don't you start with how fourth quarter was and how it's different?
So the fourth quarter was not good.
Not good.
The markets were down pretty substantially. And
substantially being like, depending on what market you're looking at, 20 to 25%.
Yeah, not good.
Gold is still solid. The Egyptians knew it. Hey, Tyrone, how are you? Yes, the Egyptians knew it best.
Yeah.
Over the really long term, that is true.
Yeah, gold's going to hold value generally because it's used across the world as value.
I'm just saying it's not everything you want to put all your money in.
That's right. So anyway, fourth quarter, there was a lot of fears of Federal Reserve rates rising or the funds rate rising. There's
just
fear
in general interest rates rising.
The government shutdown was looming. Just a lot China trade, just a lot of really negative.
Right.
Hey, Corey, a lot of just negative narratives that were out there. That
should have never went down that much. Though.
No, that caused a lot of fear.
And
we don't. And there's really not a good reason why. The fourth quarter, a lot of the numbers that came out weren't bad enough to make that happen. It's slow. The economy slowed slightly in the fourth quarter.
Well,
but
I don't know that I would say like slowed. It's just that we hit a peak. So I guess technically, yes, it slowed down
from these super highs. I mean, it was the huge growth in the second and third quarters, and then we kind of pulled back a little bit. But like the GDP numbers just came out, and we are still growing. It's just a slower growth, and actually there's more growth than they were expecting. So there was just a lot of fear that was put out there. Right. And I think that ultimately caused a lot. There was a lot of things were put on.
We were just overdue. I know that sounds crazy. Like some of you who invest in like real estate and gold or, whatever other assets that you may, businesses, some of you may be thinking, but how can the market, like how can my portfolio stocks that are fine, like nothing happened to McDonald's, nothing happened to Amazon,
right.
Nothing happened to a lot of these companies. How can I just lose value? Oops, sorry. Sorry, guys. I got a phone call. But how can I just lose value? And the answer is, oh my gosh, holy cow. Sorry. How can I just lose value out of nowhere for no real reason? And the answer is, I think now with the internet and media, it moves things because stocks are actually a representation also of future earnings.
Right.
So stocks aren't just a representation of the value of the company right now, but it's a representation of where it might be going. Hey, Brian. So, you have to realize that when the market kind of slows down a little bit, they might be selling off stocks thinking, okay, well, maybe we're not going to get the growth that we thought we might get. So that's why you have that in the market versus an asset like gold. The price is what it is, like right now, based on the supply and demand right now.
Right. Or
your house. Your house value is based on what is selling around you right now. Like it's not like, oh, what we're gonna base the value of your real estate what it might be worth in 5 years. Right. That's not how real estate works. So the market just works a little bit different. So then when we come into first quarter, the first quarter has been a lot better. So the markets have been up, the US markets especially. Mm-hmm. So if you did buy on all that craziness in December, you're looking really good right now. Europe did pretty well. Even Asia did pretty well. Not as great as the US markets, but interest rates. So the general level interest rates, like the bank, like people might be asking, like, when am I going to see interest rates go up at the bank? I'm seeing my loan interest rates go up. So you would have seen over the last year, your loan interest rates, like and credit card rates, go up. But if you're invested in bonds, your portfolios work a little bit differently than just the general level of like deposit interest rates. The times has changed because people look at the views of things and then the market changes. Gold is more valuable than what people see. Yeah, I mean, I think so, but gold is also the value of whatever you can sell it for right now. So I see what you're saying though, because the times have definitely changed.
Yeah.
But anyway, what I was saying, yields, yes. On the bond market. So the 30-year, did I bring in my sheet of paper? Holy cow, I wrote down all those notes and didn't bring in my sheet of paper. Anyway, I'll go from memory. The 30-year bond rate right now is at 2.83% for a 30-year investment. Now, the 10-year is at like 2.39. I think it closed the day at like 2.40. It'll pop up here on the TV in a second. There it is, 2.40.
Nice.
How about that? And the 2-year is 2.26. So that's if you invest in a fixed investment. That's the government debt. So when you see all this debt numbers, like, oh, we have trillions of dollars in debt, that's what they're borrowing at. They're borrowing at the 2.26 and the 2.40 for 10 years. So if you own current bonds, your bonds are valued based on those rates, not the bank deposit rate. So I just wanted to clear up some confusion there because we're down for the year on yield. So at the beginning of the year, yield is like the income, what you earn. The beginning of the year, the 10-year was paying 2.6%. Now it's 2.4%. So it's actually down for first quarter. So again, for those of you just joining, we're just doing a first quarter update, first quarter wrap up. We're also live on Instagram over here. If you guys over there are wondering why we're peeking to the side, I'm trying to read the comments because we're also live on Facebook right now, our Facebook page. We have a couple comments coming through. Hi, Sideways. But we're just doing a first quarter recap. So Ryan talked about the fourth quarter, how it was awful. So first quarter, we've gotten a bounce in the U.S. market, but bond investments, meaning like fixed investments, fixed interest rates, have actually gone down for the first quarter. So I see you have some other notes. So you want to talk about like GDP, which is growth.
Yeah,
in the economy.
So a couple of things to kind of like that are positive. I think just with so much negativity out there, just a few good things that are going on is the
things
GDP.
Are negative?
Well, there's just the whole world's outlook is negative. So a couple of good things is that the expected GDP was 2.2% growth, and it came back at 2.6. So that's good that we over.
The GDP is just the growth of the economy.
Right.
That's all
it breaks down into a bunch of different factors, but so
that's all we need.
And then good thing is unemployment is still under what's considered full employment. So we did see unemployment go up slightly, but it was so low that it's going to bounce around that level.
Eventually, because there's a lot of every business owner I talk to, and you guys comment if you feel the same, but business owners right now cannot find the workers.
Yeah.
Like they have jobs to fill, they have work that they want to do, but they can't find the workers. We had that gentleman talking in here this morning. He has 3 businesses, cannot find the workers. So eventually you're going to have to raise pay to just keep the people that you have, which puts a crunch on profits. If you don't have growth increasing and you're raising pay, you're raising expenses, you're going to crunch your profits, which eventually a few months down the road, so what to expect, not necessarily second quarter, but maybe about 12 months out, you're going to start seeing layoffs because the prices of labor have increased so much and growth isn't there. You don't have as much profit. So then that's when they lay off. So you go through this big cycle because when you have unemployment this low, you can't get the workers to fill the jobs that you have. So you end up, seeing this number fluctuate a little bit.
Yeah. And I think another thing to look at is with the bond rates, like Amy said, they're lowering. Some things that could cause that is that like the Federal Reserve has been buying for the past like decade, and they've kind of slowed down that. And so that can cause, with their demand going down, it can cause that to lower. So those are the things that are where it could be maybe put out that it's negative. It's really not a bad thing. It's just kind of becoming a little bit more true.
It's just part of the way it is when you have low unemployment.
Yeah. Consumer spending's up, which is good, which means that people are, not keeping in fear of the economy pulling back, that it's like they're spending the money, which is a good thing. Those things are good for the economy, that people aren't kind of in a mode where they're
saving mode.
Where they're kind of hoarding.
But that's also why, so when you have this situation where like a 30-year investment pays 2.8%, but yet a 2-year investment pays 2.26%, I'm going to go with the 2-year investment all day long. Why would I lock in my money?
Yeah.
So the government is kind of telling you they want you to keep your money shorter term. They want you to spend your money.
Right.
So that's a sign that they still want the economy to still be booming. They're not really trying to restrict it so bad. They've been raising interest rates for us that want loans. So when you go out to get a loan, it's going to cost you more money. Your interest rate's going to be higher. So that's a more restrictive behavior. Hey, Colin. So that's them trying to slow it down a little bit. But with other interest rates, it just kind of shows you that people are spending money right now. Like the economy is still booming because the 30-year rate has no demand. Nobody is locking up their money for a long period of time. So for those of you just joining, we're just doing a first quarter update. We're really just going over where we were in fourth quarter. Everything was bad. Everything was bad. And then
red bad.
And then first quarter, everything was like, oh, good, green, good. And so we've got, if you bought in December, like I think I went on a live, I'll have to go back and look, but I'm pretty sure I told people to buy.
Yeah.
It was a buying opportunity, man. I'll have to find that. I think I did an Instagram video actually that said like, this is a buying opportunity. Everything feels really awful, but this is when you buy.
Yeah. And that's anytime we talked about it. So there's probably a couple of videos we've talked about it, but we talked about that. We mentioned that a lot of it, we're kind of reiterating what we had said in December of, a lot of this negative is just kind of, it's the narrative, and it's not really, there doesn't make sense of why the market's down 20%. There wasn't.
Right.
So we talked about buying opportunities, and hopefully you guys got to reap some of the benefits of that.
Right. And then the first quarter has been a lot better. And then GDP was better than expected. Jobs have been kind of stabilizing, and bond yields or fixed investment yields have actually gone down, and interest rates have stayed the same. So there's your kind of first quarter update. So now where do we go next? And actually Tyrone made another comment. The stocks jump up and down all the time. Of course, when we kind of talked about that already on why they jump. When you place your money into the market, you have to play the field of a gamble. Oh, I don't know that it would be a gamble. I disagree with that. It's a gamble if you put your money in all one stock. Now I feel like that's a gamble.
Or if you're timing. If you're really trying to get in and out and day trade is kind of the best
that's
way.
Always a gamble.
That's a gamble. If you're looking long term and you're investing in good things, I mean, it's not popular, but Warren Buffett is a multi-billionaire for a reason. He buys and holds forever. So it's not popular you won't see that on CNBC because it's not fun to talk about for 12 hours a day. But if you buy good companies for a long period of time, it's not a gamble.
Right. Well, and I mean, I think everybody would agree that like if I buy Amazon or like a McDonald's, like that's not a gamble. I don't think they're going anywhere tomorrow. I'm not gambling, just hoping it works out. I mean, I think we can all agree that long term, those companies are going to be profitable. Obviously, in the short term, like if you need your money out in 90 days, I would totally agree with you that it's a gamble because I don't know where it's going to be in 90 days. So absolutely 100% on the short term, it is a gamble. And then having a marketing plan with the wealth will collect itself. People shouldn't live off what's going on inside the economy. Does your focus on creating their own economy? So maybe do your focus on creating your own economy. Yeah. So focus on like what's best for you. And that's why we talk about a lot of times, hey, Taylor, individualized advice. And you have to focus on, especially when you're in business, you have to focus on the economy so you know what financial decisions to make. So now second quarter, so where do we see it going in second quarter? So we do a lot of research on the economy just to see where we are going in second quarter. And obviously any headline could drop tomorrow and change the course of the market. But if we're going off of just economic factors, we feel like a recession is going to be pushed off about 12 to 24 months. Next quarter, we're not going to start seeing a recession, by the way, is defined as 2 negative quarters of the number that Ryan talked about earlier, the GDP, which is the growth of the economy. And so we don't feel like we're going to start to see that next quarter. That would be a huge drop, very drastic. So of course, anything can happen. However, that would be very, very drastic. So second quarter, we feel like the momentum will continue, maybe not as well as the momentum has been in the first quarter, just because we were coming off of such an awful fourth quarter.
Maybe a little bit slower growth.
Maybe a little bit slower, but we do feel like it'll be pretty good. So if you haven't gotten back in the market yet, so I had the conversation yesterday with somebody that actually was still on the sidelines from December. So cashed in the money in December out of fear. And this is when you lose money, guys. Like when you are emotional about the money and when the market gets bad, you hop out. And then you don't know when to get back in. And here we're sitting and it's really rebounded quite a bit. We're not all the way back yet, but you've missed a lot of the bounce. The question is, when do you get back in? Because it happens so quick sometimes.
Well, and you talk about it all the time being that when you do that, if you're getting in and out all the time, you're having to time it perfectly twice.
You have to be right
when to
twice.
Get out and when to get back in. And, if you're still here, not in yet, then you've missed that second.
Obviously, that makes sense. Like if you could do that, obviously, hop out right before it gets bad and hop back in when it's at the bottom. Like, obviously, that's what everybody tries to do.
If you're doing that.
You have a viewer.
Hey. Oh, it's Jason.
Yay.
Hey, Jason.
But obviously, that's what you want to do. But it's just that it's not always that easy. You have to just, in general, buy when you can on the way down. You don't know when the bottom is going to come. So don't put your full, like if you want to put $10,000 in the market, I wouldn't, and this is if you already have money in the market. This isn't a recommendation for people that have never invested, by the way. I just want to throw that out there. But if you feel like you have $10,000 to invest, I wouldn't put it all in when the market is crashing. Put in maybe $3,000. And then when the market goes down further, if it does, put in another $3,000. You know, try to just continually buy lower and lower, but you don't know where the bottom is going to be. If it rebounds right after that, great. You got some money in at close to the bottom then. Mm-hmm. So you'll get the best of both worlds if you try to do it that way. Hopping in and out drastically, like all your money out, all your money in, is tough to do. Sometimes it's doable and it really works out, but it is definitely tough to do.
Right.
So other than that, I guess we can kind of summarize and wrap up.
Yeah.
I don't think I have
20 minutes
else.
Is good.
That's good. Oh my gosh, 20 minutes already. Guys, really. Any other questions out there about just the economy or investments or just any other comments? Tyrone, thank you so much for your comments. But keep them coming. If you have any more comments, go to our website, novawealthmanagement.com, and send a comment in. But why don't you summarize real quick and then we'll...
Sure, yeah. So we started, we talked about the fourth quarter, and Jason said you've been hitting the gym.
Oh, I've been hitting the gym. Like, just very, like, literally, like, this week.
So we talked about the fourth quarter, gave a recap of just kind of what was going on, some of the narratives that were going on, and just clearly, if you follow the markets, it was a rough few months. We talked about the first quarter that we're finishing. Today's the last day of the first quarter. The markets actually closed about 25 minutes ago, so it ended the first quarter. Higher, yeah. And we talked about some of the things that the GDP, that we're still growing as an economy. We kind of gave
interest outlook, interest rates. So like bank deposit rates stayed the same, but yet like treasury, like fixed bonds went down, yields went down, like income went down.
And that a lot of things are just pointing to the economy is we're doing pretty well right now, at least as a country. There's other things we can talk about globally, but as a country, we are doing pretty well in the first quarter. We've seen a big growth, and some of that is just a bounce back, but we also have seen a lot of growth in consumer spending and things like that, which is good. And then we finished with talking about what we see in the next quarter, which may be a little bit slower growth, but that we don't see a recession coming, at least in the next 12 to 18 months, because GDP, with it still growing, it takes at least 2 quarters for it to go negative GDP for it to even be considered a recession. Right. So we're at least 2 quarters away from that, and it would be drastic in order for it to go from 2.6 growth to negative.
And the market usually is a leading indicator of that. So a lot of people's argument is like, well, if we're 12 to 18 or 24 months out from a recession and the stock market goes down 6 months ahead of time, shouldn't we start to look out for that? And the answer is, you should always look out for, you should always be diversified, have a lot of different things, have some stocks, have some bonds, have some real estate, some gold, all kinds of different things to make sure that you're not terribly at risk for any one thing to kill your portfolio. But do I think that you should be like planning for a recession today? The data at least doesn't say that. Like I said, any headline could change or anything political could change. But with the economic data, that just doesn't look likely. So using my voice to type, I think you understand. Yes. Thank you so much, Tyrone. Yeah. Yes, guys. Okay. Have an awesome weekend. We have to stop all.
Yeah, we got a lot of devices going on.
Yes, we have a lot of things going on.
Thanks for watching, everyone.
Thank you for watching.
Have a great weekend.
See you later.